Income tax is the money salaried employees pay directly to the government. The tax levied from the public is supposed to be utilized by the government to offer better infrastructure such as roads, highways, and transport. To illustrate, if A earns 6 lakh rupees a year and is liable to pay 60,000 rupees to the government, then that amount is the tax deducted from the income of the taxpayer. However, not all are obligated to pay their tax. There are two types of tax regimes: old tax regime and new tax regime. As per the old tax regime, those who earn more than Rs 2,50,000 annually are liable to file their income taxes. For example, if a person earns less than 2,50,000 per year, income tax cannot be levied on them. In the new tax regime, up to Rs 3 lakhs tax is exempted. To declare the income, expenses, and deductions, taxpayers submit a form called Income Tax Return, that is ITR, which is a form issued by the government helping taxpayers to claim deductions under Section 80C and 80D of the Income Tax Act. The deductions help individuals reduce their taxable income. It is mandatory to file income tax returns annually for the salaried employees, or else they can be penalized. However, individuals who do not come under any income groups are exempt from filing their returns. Even if not mandatory, filing income tax returns can be beneficial for individuals as it helps to establish financial records, claim refunds, and apply for government schemes. To file tax returns, taxpayers are required to have PAN and Aadhaar cards issued by the Income Tax Department and Unique Identification Authority of India, respectively. Mainly, there are two types of taxes in India: direct tax and indirect tax. Direct tax. In simple terms, this is the tax individuals pay directly to the government, which cannot be transferred to any another entity or another individual. Income tax is a direct tax which is directly paid to the government. Indirect tax. This is the type of tax levied on goods and services. This includes goods and service tax, GST, service tax, value added tax, VAT, central excise duty, stamp duty, etc. For example, A buys a shirt for Rs 1000 and the GST rate is 18%. The retailer would charge A Rs 1180, that is 1000 plus 18%. The retailer remits the tax to the government through a process called GST return filing. Minors have to file their taxes if they earn more than 1500 annually, either from a talent show or received as a gift from relatives. Their income will be clubbed with the income of the parent who earns more and they have to pay the tax. However, parents can avail themselves of a tax exemption or minor's income of 1500 per child per year for a maximum of 2 children, irrespective of how the income is earned. Minors are required to file their tax returns. To alleviate the financial burden, the government offers tax deduction or financial benefit under Section 80C of the Income Tax Act 1961 in the form of Children's Education Allowance to the families. Under Children Education Allowance (CEA), various fees are reimbursable such as tuition fees, special fees, sports fees, etc. Under tuition fees, each parent can claim a deduction up to 1.5 lakh for a maximum of two children separately.